The following podcast was recorded on Thursday, February 24th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of our podcast series, Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Today, Sam will discuss the outlook of the U.S. consumer as it relates to the global economy and markets. So Sam, in light of rising oil prices, higher food costs, geopolitical risks that are going on, what does all of this mean for the U.S. consumer?
Yeah, it's an interesting question because it does actually, Ukraine does matter to the U.S. consumer. It matters whether you look at the price of wheat that spiked on the Ukraine invasion, or oil that initially spiked on the Ukraine invasion. You know, these are real inputs to everyday consumer life. It's something to really pay attention to, and it's something that I think is kind of call it the second derivative of the Ukraine situation, is that it will blow back on the U.S. through longer than anticipated rises, cost increases. It's simply, you're not going to have a fade in oil that's enough to offset rising food costs, et cetera. So I think it's something to pay attention to, particularly since the U.S. consumer has been one of the world's bright spots over the last 9 to 12 months. The U.S. consumer has been incredibly resilient in light of a significant amount of, call it bad news. Even through Omicron in November, December, January, the U.S. consumer was fairly strong. Even with supply chains increasing prices, the U.S. consumer still showed up. I like to call the U.S. consumer the consumer of last resort for the global economy. Because when the U.S. consumer is doing well, the global economy tends to be able to ride out bumps. So paying attention to how the U.S. consumer is doing and how the U.S. consumer is likely to react in certain situations is very important to the overall economy.
And you talked about consumer spending, and consumers have continued to show up. They've been spending, in light of the supply chain constraints that we've had. But are we starting to see a slowdown? What do you predict?
Yeah, and so I think if we flip to the first chart that we have here, it's the outlook for inflation over the next 10 years. It's inflation expectations over a longer time horizon than normal. If you look at the shorter term horizons, 2 years, 5 years, it's still expected that you're going to have higher than normal inflation for a much longer period of time. But when you get out 10 years, the chances of 3% inflation over a 10-year horizon is somewhat similar to what we saw in 2013, 2012, 2013, the last time oil was $100, right? Inflation expectations are highly correlated with oil and food. So I think the U.S. consumer, to a large extent, is somewhat looking through the current inflationary environment and taking that at least kind of in stride, right? I don't think that's what's going to necessarily break the consumer. The problem is, and I think this is the interesting part, is that while the consumer has been great, the outlook for the consumer is beginning to show a few signs of cracking. This next slide is University of Michigan consumer sentiment, and most of this, it's a horrible chart to look at on its own, shows that right before COVID we kind of peaked in terms of how happy consumers were, and we've just basically been down and to the right since the beginning of COVID, right? We had a few little upticks in there when we thought COVID was over initially, and then inflation began to seem like it was becoming embedded, and then you had consumer sentiment continue to fall. That in and of itself isn't enough to really say that the U.S. consumer is going to break at some point, but it does make the U.S. consumer far more likely to be sensitive to another shock, right? We just were getting over Omicron. Omicron was beginning to fade. We were down to call it normalized COVID case numbers, pre-Omicron era. It kind of felt like we were getting there. Now we have the Ukraine invasion, right? The U.S. consumer really can't get a mental win at this point.
Yes, and we do have some COVID restrictions are beginning to relax around the world. Masks optional. There are things going on that should be viewed as positive, but how does that relate?
It's interesting. It relates well over time, right? You do want the reopening that should help with supply chains. It should help with some of the call it bottlenecks that we see in the economy. The problem is that we're opening into an already constrained energy environment. So you're going to see more of a pull on that oil supply. But it's also, and I think we talked about this last week with the truckers. It's one of those positives with a few negatives, right? Hopefully we'll see a shift from goods being bought to services, but that handoff we really haven't seen in mass, and maybe we get some goods inflation, downtick, whatnot. So I think that's important. But this next slide that we have in here is the propensity to consume via Google searches, and it's an interesting chart because we wouldn't have expected the beginning of the year to be quite this dissatisfactory on the Google searches, right? We should have seen a downtick, right? After Christmas, people tend to search for stuff a little bit less, so you have a downtick in search activity. But we wouldn't have expected it to be quite this deep, and we wouldn't have expected it to last quite this long. So it is a little disconcerting that people aren't really beginning to get out there, beginning to consume more as we move into call it the spring-ish months. If we're still if we're still sitting at these search trends in March and April, it's going to be somewhat problematic for the outlook for the economy. And the next chart I think really kind of helps drive this point home. The higher end consumer does not appear to be really showing up right now. This is the time of year where you would normally see a significant amount of bookings for Europe, right? You begin to see those really ticking up as people begin to plan their summer vacations, going to France, southern France, Italy, etc., Greece, wherever it might be. But you really haven't begun to see that uptick. And part of that's probably Omicron and the lockdown / restrictions that were in place earlier in the year in particular, but it also is probably somewhat directly correlated with Ukraine, right? And as the Ukraine situation drags on, that's going to be problematic for higher end spending, particularly to Europe, and you get some of that feedback noise. But it's a sign that not all is well within the consumption, right? We were supposed to see the handoff to services, vacations, people pent up at home, really wanting to get over COVID, get out of COVID, move on. And at least when it comes to travel to Europe, we really haven't seen that, and it's underperforming significantly. So if you begin to see some stabilization in Ukraine and you don't begin to see travel to Europe picking up, at least on the margins, it's going to be a sign that maybe not all is well at the high end of consumption. And we already know that as food prices and gasoline prices rise, that's very bad for the lower end of the income spectrum in terms of consumption as well.
And can we turn next and talk about real wages? They had spiked during the beginning of the pandemic, but are they holding up with inflation?
So they're not. It's a really interesting narrative that we continue to hear, that wages are rising. We can't find people even with raising our wage by XYZ. The interesting thing is that we just haven't seen real wages actually keep up with the inflation spike. I mean, it's great that during COVID we had that big pop in real wages, but you've seen down and kind of trickling back, and it's actually kind of broken the trend line as we go back to 2016, 2017. That's problematic for the U.S. economy, particularly when we really need the consumer to shift to services, begin to go out, begin to really pivot consumption from goods to services, and drive an economy that looks a little bit, call it shaky, as we move into the summer months. So this is one of the more problematic charts to me, If we don't begin to see real wages rise, that can happen two ways. One, you can get a break from inflation, or two, you can get wages higher. If you don't begin to see inflation come down or the nominal wage begin to rise a little more sharply, it's going to be hard for the consumer to continue to drive the U.S. economy when there's no transfer payments coming anytime soon. We don't have a significant fiscal spending bill going through Congress anytime soon. That's going to be somewhat problematic for the outlook for the U.S. economy.
Well, Sam, thank you for your thoughts today, and thank you everyone for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For further information or any questions, please contact Gus Handler at gus.handler@arborresearch.com.